Welcome to this deep dive. Today we're looking at something called chattel mortgages. Maybe not the flashiest topic, but pretty practical.
Definitely practical. We've been looking at this, especially through a source called Chattel Mortgages Made Simple, a grandma-friendly guide.
Right, that guide. Sounds simple, but we want to go a bit deeper, don't we?
Exactly. Our mission here is to really unpack it, how it works, why it works, and who it might actually be useful for, whether that's personal stuff or business.
Yeah, because it seems like a way for people or businesses maybe who don't have the usual collateral, like a house, to still get financing.
Precisely. It uses a different kind of asset altogether. It's about, well, understanding another tool in the financial kit.
Okay, let's get into it then.
Hmm?
What is a chattel mortgage? The name sounds, I don't know, a bit old-fashioned.
It does sound a bit dated, yeah. But
Mhm.
the idea is very current. Basically, it's a loan secured by, well, personal property, movable property.
Chattel is the key word there, right? Meaning movable stuff.
Exactly. That's the legal term for it. Tangible, movable, personal property. So,
Yeah.
crucially, not real estate.
Not your house, not land.
No. We're talking things you can, physically move
Yeah.
or things that aren't fixed permanently.
Like what sort of things are we talking about?
Oh, common examples are things like cars, trucks, RVs, boats are big ones.
Okay.
But also heavy machinery, think farm equipment like tractors, maybe equipment for a restaurant, that kind of thing. Sometimes even store inventory.
And that item, the chattel, is the collateral.
Correct. It's the security for the lender, like
Yeah.
a safety net. The borrower can't pay back the loan. The lender can take that specific item
You get their money back.
to recover their funds, yeah. It's tied directly to that asset.
The source had that teapot analogy, like leaving your teapot with a friend as a guarantee.
Kind of like that, yes. Or the baker needing a new oven example, which is maybe more direct.
Ah, yes.
They need the oven, they get a loan for it, and the oven itself acts as the collateral.
Okay, that makes a lot of sense. The asset secures its own financing in a way.
Often, yes. Or it secures financing for something else. What the lender really cares about is the value of that item.
It's conditioned too, presumably.
Yeah.
Like grandma checking the appliance.
Absolutely. They look at the value, the condition, how easily they could sell it if needed. Marketability is key.
So how's this different from just a regular secured loan then?
The main difference is the type of collateral. Traditional mortgages use real estate. Other secured loans might use, I don't know, savings accounts or a mix of things. A chattel mortgage is very specifically built around one valuable, movable piece of property.
Got it. Focused on that single item.
Right. And the source mentioned something about flexibility, talking to the lender.
Yeah, it hinted at negotiating lower interest or working out payment plans.
That's definitely part of it. Because the loan is tied to a specific asset, sometimes there's a bit more room to tailor things, maybe aligning payments with how the asset earns money, for example.
Okay. That's interesting. More tailored than the standard house mortgage might be.
Potentially, yes. It offers flexibility, which can make financing easier for some folks without all the hoops of traditional lending.
And it's not just for big companies, right?
Yeah.
The guides stress that.
Oh, absolutely not. That's one of the big myths we should probably bust.
Okay, yeah. Let's tackle those. Myth number one. Too complicated.
Yeah, the idea that it's only for, like, finance wizards. It's really not. The basic idea is simple. You use something you own, something movable, to secure a loan.
Like pawning something, but with a plan.
Sort of,
Right.
but more structured, with a formal loan agreement and repayment schedule. But the core is leveraging an asset you possess.
Okay. And myth number two. Only for huge corporations.
Definitely not true. Small businesses use them all the time. Think farmers, owner-operators with trucks, craftspeople.
Like the farmer using a tractor for seed money.
Exactly. Or a crafter using their high-end sewing machine to buy bulk fabric. It scales down perfectly fine. Even individuals buying a car often use a form of chattel mortgage.
Right. The car loan itself is often structured this way.
Precisely. The car secures the loan used to buy it.
Okay, what about the idea that these are only for people with bad credit? Is that a myth too?
That is a really important one. Yes, it's largely a myth.
Right.
While it can be an option for someone with credit challenges because the asset provides security.
The lender has the item to fall back on.
Right. But you absolutely don't need bad credit. Plenty of people and businesses with good credit use chattel mortgages.
So what do lenders look at then, besides the item?
They still look at your ability to repay. Income, cash flow if it's a business, your overall financial picture. Good credit definitely helps get better rates and terms.
So it's really about the asset being the primary security, but not the only factor.
Correct. It's not some kind of last resort loan exclusively. It's a specific tool for leveraging specific types of assets, whether you're grandma wanting a knitting machine or a shop needing inventory.
Good to clear that up. Ditch the old ideas.
Exactly.
Let's go back to those real-life examples. They really help make it click. The bakery owner again.
Okay, the bakery. Business is good, needs a bigger mixer, doesn't own the shop building, so no real estate mortgage. Maybe the bank says no to an unsecured loan.
Right.
So they get a chattel mortgage. The new mixer is the collateral. They get the loan, buy the mixer, make payments, hopefully from increased business.
And they keep the mixer and grow.
That's the idea. The financing is directly enabled by the asset itself. It unlocks that purchase.
What about the person wanting a car?
Similar concept. Maybe you don't have a huge down payment or you want to keep your savings intact.
Okay.
You get a loan using the car's collateral. The lender approves it based heavily on the car's value. You drive away, planning to pay it back over time.
And the source mentioned maybe negotiating a bit if the car is in great shape.
Yeah, potentially. A newer car in good condition is better collateral, so it might give you a little leverage on the interest rate, depending on the lender and your credit profile, of course.
These examples really show how it can be, well, a lifeline sometimes.
It really can. It opens doors that might otherwise be shut, especially if you don't fit the traditional lending mold focused on real estate or perfect credit scores.
So zooming out, why is this whole concept of chattel mortgages actually a big deal? What's the core value?
I think the core value is really about expanding access to capital through flexibility.
Flexibility again.
Yes. For businesses, it means they can buy equipment or inventory needed to grow, maybe faster than waiting for a big traditional loan approval.
Like the construction company getting a bulldozer, you mentioned.
Right. They use the bulldozer as collateral, maybe take on a bigger project they couldn't otherwise, and boost their income. It directly fuels growth.
And for individuals.
It's a way to afford major purchases, a car, an RV, a boat, without maybe draining savings or needing to tap into home equity, if they even have it.
So it works by letting you use the value tied up in movable things.
Exactly. You're leveraging personal property to get access to funds that might not be available otherwise. It fills a gap.
It seems especially important if, say, traditional banks are hesitant because you lack real estate, or maybe have a shorter credit history.
Definitely. Or if you're just starting a business, or even in rural areas sometimes where maybe banking options are fewer. Think about that gardener grandma example.
Using her greenhouse as collateral.
Yeah. Using the greenhouse to get funds for seeds and tools to start a small business, it makes these kinds of ventures possible. It helps level the playing field a bit.
Giving more people a chance to grow, whether it's a family needing a car or a small shop needing equipment.
That's the essence of it.
So wrapping this up then, we've seen chattel mortgages, our loans, secured by personal property, movable stuff, not houses or land.
Right, and they're a really viable option for people or businesses who maybe don't have those traditional assets or whose needs center around specific equipment or vehicles.
Back to the teapot promise analogy, kind of, but more official.
A much more official version, yes. But the idea of using a specific item as the guarantee holds.
And the benefits are clear. Flexibility, they're not as complicated or exclusive as some myths suggest.
And they really can help people achieve goals, getting that car, buying necessary equipment, funding that dream project.
It's another tool to know about in your financial toolbox.
Absolutely. A distinct and often very useful one.
Which leads to a final thought for you, the listener.
Yeah, think about your own situation. What movable property do you own? Or what significant movable item might you need for your personal goals or your business?
Could this type of financing, leveraging that specific asset, actually be a good fit for you?
Something to consider. How could using the value of that specific item help you move forward?